The advice was simple. Spend less than you earn. Save the rest. Your future self will thank you. Something has shifted in ways the conventional advice framework has not fully absorbed. A dollar held in savings loses purchasing power in real terms. This episode is not an argument against saving. This is an argument for saving intelligently. The arithmetic tells a story most people find genuinely surprising. Let us work through it. The Consumer Price Index, maintained by the U.S. Bureau of Labor Statistics, is the most widely cited measure of inflation. It is not a perfect instrument. Economists debate its methodology, but it is the most consistently tracked benchmark we have. The Federal Reserve's 2% annual target. During the 2021 to 2023 period in particular, U.S. Bureau of Labor Statistics, data current as of production date. CPI is one measure. Individual experience varies by location. The practical implication for savers is this. A dollar loses purchasing power in real terms, even as its nominal value stays the same or increases slightly. This is not a conspiracy or a policy failure. It is arithmetic. Requires more nuance than simply saving more money. Traditional savings accounts lagged significantly behind inflation. High-yield savings accounts increasingly available, following the Federal Reserve's rate increases beginning in 2022. The purpose of this comparison table is not to tell you what to do. Loses purchasing power every year it holds your money. Produces a modest positive real return. That is the number that matters for your purchasing power. These are illustrative figures. Consult a fee-only fiduciary financial planner. Before we continue, a practical moment. What interest rate is your primary savings account paying you right now? Not approximately, the actual number. Pause this video if you need to. Look it up. If you do not know that number, you are not alone. And that is why we are spending time on this. Now, the alternatives landscape. The choice is not binary between savings and the stock market. Cash, maximum liquidity, FDIC insured, may lose real purchasing power. High-yield savings, FDIC insured, better rates, some variability. CDs, FDIC insured, fixed rate, limited liquidity, penalties. Treasury bonds, government-backed, not FDIC, but backed directly. Corporate bonds, higher yield, credit risk varies, not FDIC. Index funds, long-term growth potential, short-term volatility. Individual stocks, highest return potential, highest risk. A range of vehicles with meaningfully different risk profiles. Consult a fiduciary financial planner for personalized guidance. But the vehicle you choose is only half the story. Here is the variable that most investment discussions underweight: behavior. Dalbar, a financial research firm, publishes its quantitative analysis. A significant gap between fund returns and investor actual returns. The mechanism? Investors buy more after markets have risen, after much of the gain has already occurred, and sell after markets have fallen, locking in losses. Chasing performance, fleeing volatility. Dalbar's methodology has been questioned by some researchers. The directional finding is broadly supported. Vanguard's own research, in their Advisors Alpha white paper, that attributes value specifically to behavioral coaching, helping clients not make emotionally driven decisions, Access to better investment vehicles does not automatically produce better outcomes. How you behave is the primary driver of long-term outcomes. Whether you can stay disciplined through volatility, automating decisions, low-cost index funds, long holding periods. Not because these are the only legitimate approaches. The question of where to put your money is less than half. How you behave over years and decades is the other half. Savings accounts preserve nominal value, but may lose real purchasing power. The spectrum of alternatives has meaningful differences. Behavior over time matters as much as vehicle selection. Everything is educational context, not financial advice. In Episode 4, The Credit Scorecard. Sources in the description. Subscribe for Episode 4. Let us work through the key trade-offs. Cash and high-yield savings are immediately accessible without penalty. Most investment vehicles are not or carry costs if accessed early. Money needed within 1 to 3 years should not be in volatile assets. This is foundational. FDIC-insured accounts insured up to $250,000. Investment accounts are not FDIC-insured. You can and do lose principal in market downturns. Every point involves a genuine trade-off between safety and growth potential. The case for equity investing rests on long holding periods. The longer the horizon, the more time to recover from downturns. Short-term needs should not be funded by volatile assets. Matching your vehicle to your time horizon is critically important. Different vehicles have different tax implications. Each has different limits, tax treatment, withdrawal rules. This matters significantly over decades. Tax strategy is highly individual. These 4 dimensions form the analytical framework. These are the questions worth asking. A fee-only fiduciary financial planner is legally required to act in your interest. Ensuring you ask informed questions is the prerequisite. An informed consumer of financial advice is a protected consumer. Frequently cited in investment discussions, individual investor returns vary significantly. Investment costs compound over time, working against you. Wise Owl explaining low-cost index funds. Diversification reduces individual security risk. Automating removes the emotional decision point. Investing a fixed amount regularly? Time is the most powerful variable in compound growth. A 10-year head start can produce a dramatically larger outcome. The decisions you make now are ones your future self will thank you for. You now have the framework. Consult a fee-only fiduciary financial planner before making decisions. Let us bring this together. Cash sitting idle loses real value. There is a full spectrum between cash and stocks. 4 dimensions that matter. Behavior over time often matters more. 4 points. 1 clearer picture. But nothing in this episode is investment advice. In Episode 4, The Credit Scorecard. What it actually measures, what it does not. Why the distinction matters more than most people realize. Sources in the description. Subscribe for Episode 4.